Tomorrow is the moment of truth for stocks. For stocks like Tesla, interest rate sensitive names, small and mid caps. This is no exaggeration. Tomorrow could dictate how markets trade for the next 3 to 6 months, absent any weird anomalies that happen that are unforecastable, like black swan events, which are by nature unforecastable. So tomorrow is the most important day. And this is the most important video to get you prepared for tomorrow. We're going to go over the expectations for the Fed, what we think the Fed might do or say, and how this could affect Tesla stock. There's a very real chance that Tesla stock could enter a new regime starting tomorrow. Either a very bullish one or not such a bullish one. We have all of the latest information that you need to know. We do have an interesting post that we're going to look at on X as well, just comparing Tesla back in 2020 and 2021, the business and the fundamentals to where it is today. I mean, it's incredible. Tesla stock has a lower market cap now than it did then, and the business is doing way better. So I think that's fascinating as well. We have a lot to cover in a short amount of time. Let's go ahead and jump straight into it. If you guys find value out of this video, hit that like button and subscribe to the channel. Thank you for watching, and let's get started. So the simple version to explain tomorrow is the markets are expecting 4 rate cuts. The Fed told us in September they were going to cut rates once in 2024. If the Fed does not get in alignment with the markets, some of this latest rally that you have seen in some of your interest rate sensitive names, your small cap names, well, it's over with. It's done. At least for the next 3 to 6 months. Because that's going to push treasury yields up dramatically coming tomorrow. And that's going to dramatically push up the odds of a recession. So there's a lot of different moving parts here. How many rate cuts we get from the Fed can have direct implications on the probability for a recession. So this could spark a huge rally in the instance that the Fed does get in alignment with the markets. I've said it before and I'll say it again, and I think it's very important for you to understand. It's one thing for the markets to price in 4 or 5 rate cuts. It's another thing entirely for the Fed to price in 4 or 5 rate cuts. The other side to this is what is known as the dot plot. So we're going to get estimates for PCE, for unemployment, for GDP, and for the Fed funds rate. These are estimates that will go out 3 years. This is what the last summary of economic projections looked like in September. Now, this is the dot plot itself for all kinds of different things. It's basically the members of the FOMC committee. They go out and they literally put dots on a chart, and then we kind of get the average estimate from Fed members. So Powell could be, way lower on the federal funds rate than the next guy, but it all averages out to the same. And we don't know who's a voter, who's not a voter. So the numbers can get a little bit tricky here. But generally speaking, what the Fed projects is usually what the Fed does. So back in September, the Fed was expecting the Fed funds rate by the end of 2024, so by December of 2024, to be 5.1%. That was the Fed telling us they were going to cut rates once. About mid-year, around July, they were pricing in a rate cut. Well, the Fed also expects good GDP next year. They expect 1.5% GDP, no recession. That's the other side to this. If the Fed funds rate comes down, the projected rate, down to 4.6% again, like it was in June before they raised it to 5.1%, well, that would be pricing in almost 4 rate cuts. So at least 3 rate cuts. That's going to be okay. That's going to be decent. If the Fed funds rate projected rate by the end of 2024 comes in around 4.4% or even lower, that could be very good news. Why I say it could be, because you got to look at GDP in that instance. If GDP stays the same at 1.5% and the Fed's expecting 4 or 5 rate cuts next year, that is your defining moment that could cause a multi-month rally in stocks. This could be a rally in which you have not seen since 2020 and 2021. This could be a euphoric, a very much FOMO-like rally. To the contrary, if the Fed, for whatever reason, this seems unlikely to me given how strong the economy seems to be doing, but in theory, if the Fed were to project, let's say, where the markets are, 4 or 5 rate cuts, maybe they go out to like 6 or 7 rate cuts and project the Fed's funds rate at 4% next year. Well, that's great. But if GDP estimates were to come down to like 0.3%, that would be the Fed basically saying, you might get a recession next year. That wouldn't be as good, but still would be pretty good at the same time. So the best possible outcome here is the Fed prices in 4 rate cuts, how the markets are currently pricing in 4 rate cuts, and GDP estimates stay the same or go higher. Now, the unemployment rate can be important as well, but really, if you're looking at the possibility of a recession, that comes down to GDP. So that's probably going to be most important. Unemployment rate, I'm not expecting much to change there. PCE estimates, actually, these could move lower, which would justify and support the Fed funds rate by the end of 2024 also going lower. There is currently $6.15 trillion sitting in money market funds. This is money that is investable money. This is not bill money for households. This is not, vacation money. This is money that is already invested in markets. It's just in money market funds. Money market fund money is very maneuverable, because you can sell out the same day, get your money back, and just get out of a money market fund. Put your money into stocks the same day if you would like. So there is a huge pool of capital waiting on the sidelines. What seems like to me, they're waiting for the Fed's confirmation of lower rates in 2024, or 4 or 5 rate cuts in 2024. That would be the confirmation the markets need to put billions, maybe $1 trillion or more, back into stocks. Now, the stocks that would obviously benefit the most are interest rate sensitive names. I think it takes no genius to figure that out. That would be small, mid-cap stocks. That would be stocks such as Tesla. Specifically, why I think tomorrow you could get such a large move in our markets is because we're so far disconnected from what the Fed said in September. So if the Fed really doesn't change much from September until, today, in the last 3 months on the dot plot, and they're still expecting Fed funds rates to be about 5%, 5.1% by the end of 2024, they don't change anything. Well, markets, stocks, bonds have gotten the Fed totally wrong here. And you would obviously see treasury yields soar. You would see money rush out of stocks, faster, than you have probably ever seen before. To the contrary, if the Fed is in alignment with the markets, then you're going to fill this gap, right? So the markets are way down here, this red line, pricing 4 rate cuts. The Fed's way up here, pricing in 1 rate cut. That we've never seen before, not in recent times, where the markets have gotten so far ahead of the Fed. And it's because of the economic data, right? The data has come out okay. Definitely not a red hot economy following the Q3 GDP report we just got. It looks like GDP is going to come in a lot lower than it did for Q3 in Q4. It looks like the labor market is holding up, but it's not running red hot. You're really seeing inflation falling off of a cliff over the last couple of CPI reports. There's a logical reason why the markets are pricing in 4 rate cuts. But we need that said from the Fed. So there's just a big divergence here from what the Fed said last time and what the markets are now pricing in for the Fed. Any false move here, any error in market pricing could be a big problem. I personally think the Fed's probably going to come in alignment with the markets, if not pretty close. And if they're pretty close or come in alignment with the markets, that's going to be fantastic news for stocks. I also shared this post yesterday as well. I shared this in the video that was put out last night. This is net fund manager stock exposure. So basically in 2022, there was the largest net short position on stocks that you've really ever seen, right? As a percentage of portfolios, about 60% of portfolios were net short on stocks. That just doesn't happen when markets tend to go higher. People tend to be bullish by nature, but not in 2022. You were actually more bearishly positioned in 2022 than 2008. I think that tells you something. Well, now you've started to see a rally in sectors of our markets. Stocks have done okay throughout 2023. Recently, the average stock has started to do a little bit better. You're still at about 2% net long our markets. So during a bull market, you can get 60, 70 plus % net long in stocks from hedge fund managers. You're not even remotely close to that. That's why I think a euphoric FOMO-like rally could come if the Fed is good tomorrow. And actually, today was the first important day. And then we're going to have two more, Wednesday and Thursday. Today was all about inflation. Tomorrow's all about the Fed. And on Thursday is all about the economy with retail sales, export prices, and import prices. That's going to potentially drastically change the GDP forecast for Q4. It's unclear if the Fed already has those numbers, but I would argue maybe they do. Today's inflation report, though, came in basically in line with expectations across the board. So inflation did go higher a little bit on your core month over month. Core year over year came in at 4%, right in line with estimates. Inflation month over month on the headline came in at 0.1%, in line with the estimates. And inflation year over year actually fell to 3.1%. That was in line with estimates, down from last month's rating of 3.2%. So you did see a little bit of a down move in some areas, but really we just came in line with expectations. Now, based on what we've seen in the markets today, really two things could have happened. If you look at the indexes themselves, the Dow was up 0.5%. The S&P was up about 0.5%. The NASDAQ was the outperformer today, up 0.70%. The Russell 2000 was actually down about 0.13%. So some of your interest rate sensitive names did not do well. Some of this could be selling in anticipation that maybe the Fed could be, on the more hawkish, aggressive side. Maybe they're not expecting as many rate cuts as the markets. But the NASDAQ outperforming today, that's a good sign. The VIX getting crushed today could be a good sign as well. I say could be because normally if you're heading into a major volatility catalyst the next day, if you watch the VIX get crushed, it can sometimes be a good time to put on puts on your portfolio, because when the VIX falls 4.43%, that's a large move down. That's basically saying puts are getting sold, calls are being bought on our markets. Considering the rise in the VIX we have seen over the past couple of days, I'm not going to read into this too much, but it could be a good sign heading into tomorrow. A lot of the times, if you're going to have a negative catalyst coming the next day, stocks will at least be down a little bit beforehand. That obviously did not happen today. So my central bias is bullish around the Fed, around the dot plot. I don't think the Fed's going to forecast a recession. I think the Fed's going to forecast more rate cuts than what, they did in September. The potential problem could be if the Fed signals they might cut rates 3 times instead of 4. Markets are currently pricing in 4 solid rate cuts. If the Fed only says they're going to cut 3 times, I think it's a real toss-up between, is that good news Or is that bad news? That's 2 more rate cuts than the Fed was expecting 3 months ago, but not as many as the markets are currently expecting. Then I think the move, could go in either direction. It's really hard to make a call at that point. I think it would depend a lot on the unemployment rate, on where the Fed thinks inflation will be, right? Where the Fed thinks the economy will be as well. Today for Tesla stock, you had 743 orders, totaling $1.32 billion in the options market for Tesla's options, with a positive order value of 18%. So 18% definitely shows some hedges were being placed on Tesla stock, which again is not uncommon right before a big catalyst that could literally change the markets for the next 3 to 6 months for better or for worse. Tesla shorts are also going to be in a very bad spot if we do get a positive reaction coming tomorrow, because Tesla is so interest rate sensitive, and you currently have $21.4 billion worth of short positions on Tesla stock. If Tesla goes higher from here, shorts are going to be taking a massive beating. And heading into a new year, it's probably not where you want to be, is short in Tesla. Now, this post about Tesla, really looking at the fundamentals of Tesla back in 2020 compared to now, it was posted by Dylan Loomis. I did go ahead and share it on our X account. Go ahead and follow it. It's Michael Tyler. And I did go ahead and just follow in there because this post is pretty eye-opening for a lot of people, I do think. He writes, in August of 2020, the market cap of Tesla reached $780 billion. Tesla's trailing 12-month figures at the time: deliveries, 430,350, operating margin of 6.1%, GAAP net income, $556 million, and free cash flow of $1.9 billion. Tesla's current market cap is about $25 billion less than what you've seen in 2020, at $755 billion. Current trailing 12-month figures: deliveries, 1.73 million, operating margin, 11.2%, GAAP net income, 10.8 billion, and free cash flow of $3.7 billion. I think this really highlights how the Fed raising or lowering rates can affect valuations in our markets. If rates were zero, Tesla stock could be $1,000 per share right now, based on extrapolating some of this value, right? Tesla could be a $2 trillion plus company. But when rates are 5.5% and the Fed's screaming higher for longer, it puts a huge dampen on Tesla. And that's why, if we do get the rate cuts, the 4 that we're expecting from the Fed, and that's also the Fed's projection, well, this could dramatically boost the multiple that people are willing to pay for Tesla, especially, again, I know I sound like I'm beating a dead horse here, but it's important, especially because Tesla is probably the most interest rate sensitive company out there on our markets, so they're likely to benefit the most. It's interest rates going higher have been the biggest drag on Tesla's business, but also Tesla has a degree of safety that you just won't find out there in interest rate sensitive names. Most interest rate sensitive names are low quality companies or super small cap companies that not even enough analysts follow to, make it worth your while to invest in. The risk is a lot higher in just random small and mid cap companies. Tesla, sure, you can lose money. Are you going to lose all your money? No. Are you going to lose half your money? Possible, but unlikely. Are you going to double up next year in Tesla? Potentially. Are you going to triple up next year? Potentially. You get what I'm saying here, right? The risk reward looks very favorable in Tesla as the lower rates do go. Tesla stock was down about 1.14% here on the day today. You're up about 0.05% in after hours, so call it roughly about 1.1% you were down today. Now, something fascinating is happening on the technicals yet again. Over the past 5 trading days now, you have found support on this downtrending line of resistance, like perfectly. Today, you bounce off the 50-day moving average. That's awesome. That's great. and you found support at this downtrending line, literally perfectly at $237. You're currently at $237.07 per share. Now, this does show the bulls took control of Tesla stock today because you were trading at low levels, right? Around $234 per share when you hit that 50-day moving average, and you rallied towards the high of the day. That's a really good sign heading into tomorrow. That's just a good sign overall for the bulls in Tesla stock. The RSI is at 50.93, which is indicating the stock is exactly neutral. It really couldn't even get more neutral from here. And the MACD is still pretty dang positive. Now, you are getting a convergence where the yellow line is almost going under the blue line. That's not great in the short term, but you really can't draw any conclusions necessarily just off of what the MACD is doing. Tomorrow morning, you're also going to get PPI month over month for November. You're expecting 0.1%. Last month's number was negative 0.5%. So you are expecting a not deflationary number coming tomorrow. I don't think that's going to matter basically at all. I think the big story is obviously going to be around the Fed. Now, the summary of economic projections, the dot plot, where we get the Fed's projections for 2024 for, again, GDP, unemployment, PCE for the Fed funds rate, all of that. We're going to get that comes out at 2 p.m. And then the press conference comes out at 2:30. Now, what's a little bit different about this Fed meeting, or really any of the summary of economic projections, is when we get the projections, well, it's really not going to matter what Powell says on the conference call. Unless he says something off the walls that is just really good or really bad, it's not going to matter. At 2 p.m. on the dot, you're going to know if we could potentially rally for the next couple of months or crash for the next couple of months. That's why I either suggest you join the trading community if you have not done so already. I will keep you guys posted and updated over there with the live interpretation of whether or not this is good or bad. Coming out right at 2 p.m. We're going to be trading this as well. This has huge implications for the next 3 to 6 months. Of course, we're going to be trading this. Or you can follow the X account of Michael Tyler, and I will give you a overview of, what the summary of economic projections is saying, if this will be good or bad for months to come. The quicker you get that information, potentially the more money that you will make. But it's really all about 2 p.m. this time, not as much about 2:30. Normally, just normal Fed meetings, 2 p.m., you'll get a move, but it's really all about what Fed Jerome Powell says. Not tomorrow. It's all about the summary of economic projection. Let me know what you think about all of this information down below in the comment section. Do you think stocks are going to do well tomorrow based on the Fed? And what is your estimates for rate cuts coming next year? Let me know all of that information down below in the comment section. Are you buying? Are you holding? Are you waiting? What are you doing with your positions and your trades? Personally, I think it's a very good choice to even wait until 2 p.m. tomorrow to get confirmation, then play whichever direction, the summary of economic projections suggests markets will move in. And that's kind of our plan heading into tomorrow as well in the trading community. Like I said, if you guys want to join that, link down below in the description of this video. That is going to do it. My name is Michael Tyler. Enjoy the rest of your day, and I will see you in the next one.